Here is something that happened in this hobby that almost no one talks about analytically. A messy PSA 10 sells at auction. You get a big number. It hits Card Ladder. It gets screenshotted. It gets posted on Instagram with the rocket emojis. And within 24 hours, 3 collectors reprice their buy it now listings upward based on that single sale. That's not price discovery. That's one transaction in a nearly empty room being treated as market consensus. And if you've ever tried to actually sell a card at the number on your screen, you already know what I'm about to tell you. The price is not real. Or more precisely, the price is only real if the market behind the price is real. Today, we are going deep into what liquidity actually means for sports cards. Not the textbook definition, not a vague hand wave you hear on a YouTube break, but the mechanical truth of how thin markets move, why your card ladder comp lies to you, how to spot when a trend is running out of gas, and how to exit a position without destroying it. This is the episode I wish I had before I started trading this asset class seriously. Let's go. Finance breaks liquidity into 3 types, and all 3 of these matter for cards. None of them are talked about in this hobby with any precision. The first one is market liquidity. It's the most intuitive. Think of it like an auction room. High market liquidity means the room is packed. You walk in, announce you're selling, bids come in fast. The price barely moves because there are enough competing buyers to absorb your sale without any single buyer having leverage over you. Low market liquidity means 3 guys are sitting in folding chairs in the back. You need to sell, they know it. You keep dropping your price until one of them shrugs and says, yeah, fine. That violent drop in price caused by your own desperation to transact, that's called price slippage. In equities, it destroys institutional trades. In card markets, it destroys your comps. Here is what that looks like in practice. The soccer index on Card Ladder is averaging just 28 transactions per day across the entire category. 28. Basketball does 463, baseball does 410. So soccer's entire market is 3 guys in folding chairs, and 2 of them are only there for Messi. When you try and sell a mid-tier soccer card into that environment, you are not selling into a real market. You're hoping one of the 3 guys wants what you have at the price you want on the day you are trying to sell. The second type of liquidity is called asset liquidity. This is the nature of the thing you're actually trying to sell, not exactly the room it's sold in. Finance uses a clean example here. A share of a large cap stock takes only 13 milliseconds to sell. Cash hits your account almost instantly at the fair market price. But now try selling a multi-million-dollar Picasso, if you have one of those lying around. You're going to need authentication. You're going to need a sophisticated and specialized buyer. You need weeks, sometimes months of negotiation. And if you need cash tomorrow, you're going to take a steep haircut. Sports cards are not stocks. They're closer to the Picasso than most collectors want to admit. It's hard to sell a PSA 10 at 2 p.m. on a Tuesday and have the money by 3 p.m. You need a buyer to find the listing, or you need the auction to run. You need eBay to then process the payment. You need the card to ship. It's a 7 to 14-day process minimum. And the higher the price point, the more illiquid the asset. A $50 base card has dozens of buyers at any given moment, whereas a $15,000 vintage PSA 10 might have 3, maybe 4. I've said it before, and it's worth saying again, forced sale equals death to ROI. The collector who needs cash this week does not get to choose the price. The market chooses for them. Liquidity is thus not just a metric, it's freedom. The day you need to sell is the worst day to be selling an illiquid asset. Now, the third type happens when forced liquidity cascades through a system. In 2008, banks started dumping their most liquid assets, treasury bonds, equities, just to meet their obligations. This selling created more selling. Prices dropped, which triggered more obligations, which triggered more selling. You might have seen this in the hobby a little bit. A major collector starts to liquidate, dozens of cards hit the market simultaneously, the comp stack craters. Everyone who held the same cards watches their paper value evaporate. Concentrated positions in illiquid assets carry this risk in both directions. This is the one I want you to hear most clearly. Card Ladder is showing you the last sale. It does not show you the depth behind it. It does not show you how many other sellers are listing at the same price, at a lower price, or how quickly the next buyer might arrive. It shows you one transaction and implies it's a market. Now, in equity markets, there's a concept called the price impact factor. It measures how far a price moves based on the size of your order relative to the available depth. In deep liquid markets, you can sell 50,000 shares of a stock, barely move the needle. In thin markets, however, a fraction of that order size causes violent price movement because you are running out of buyers at each price level and jumping to the next one, and the next, and the next. The card market equivalent is what happens when you hold multiple copies of something. You own 5 copies of a PSA 10, you list one, it sells at $400. You list another, it sells at $370. By the third, you have started to crater your own comp. By the fifth, you've told the market this card has no real bid at $400 anymore, and every other seller is going to adjust accordingly. This is price slippage in card form. It was invisible until you tried to sell. The buy it now versus auction gap compounds this. Now, you might remember I analyzed this in episode 38, that auctions clear roughly 14% less than buy it now on average. That gap isn't random. It's the difference between what a seller wishes a card is worth and what a buyer is actually willing to pay at the moment of a transaction. That spread is the real-time health meter of market liquidity. A thin spread equals thin market equals danger. Here's the part that might be counterintuitive. Thin liquidity is not just dangerous on the downside. It's also the engine of the biggest upside moves in the hobby. In a deep liquid market, a rising trend gets absorbed constantly. Sellers take profits at every price interval. There's friction at every level. Price creeps up slowly because there are people willing to sell into every bid. Contrast that to a thin market. When buying pressure arrives, there's nothing in the way, no friction. The price doesn't tick up, it just launches. There are no sellers resting between here and 30% higher because the market's too thin to have populated that depth. This is exactly what happened to soccer cards in 2025. The index went up 91% year over year, not because of 91% more demand, but because the supply ladder in soccer does not exist. There's no mid-tier bid depth. So when capital flows in at the flagship level, it hits an empty order book and the price runs unchallenged. The identical dynamic works in reverse. When selling pressure arrives in a thin market, there are no buyers on the way either. So the price doesn't tick down, it falls. This is why soccer is the highest conviction trade with the most binary outcome. Thin liquidity is a feature when capital is flowing in, but it's a trap when the capital needs to flow out. That same architecture that produces 91% gains can produce 30% drawdowns on low volume. A handful of sellers, no bids in the way. The rocket becomes an elevator shaft. Understanding which direction the pressure is flowing and whether you have time to be on the right side of it is this entire game. Now let's talk about how to spot when a trend is running out of gas. Finance has technical tools for this. RSI, money flow index, candlestick rejections. I'm not going to translate those directly because cards don't really trade in real time like that. But the underlying concept is essential. A trend running out of gas does not stop instantly. It doesn't just hit a brick wall. It's more like a car that runs out of fuel on a flat highway. The engine cuts out, the car coasts and putters along for a while. To the uninformed observer, it might look fine, but then it stops. The amateur enters the trade while the car is coasting. They see forward movement and interpret it as engine power, but by the time the car stops, they're fully invested. Here's what you actually observe in card markets. Volume without price. If a card is trading at high frequency, but the price is not making new highs, the buyers are there, but they're not willing to pay anymore. They have the leverage. The trend is coasting on inertia, not conviction. That's the gap between price discovery and wishful selling. Buy it now accumulation without clearance. If you watch the number of buy it now listings grow while sold comps stay flat, sellers are pricing into yesterday's market and buyers are not confirming it. The spread is starting to widen, the engine is out. Fringe cards leading. Now, when base cards and low-tier duplicates start getting posted as if they're investment grade, you're in the late innings. When you see those base cards absolutely pop off, capital is chasing it down into lower quality assets. This is like when the shoeshine boy starts giving you stock advice. The professionals who made that thesis trade and started the ball rolling have already gotten out. The question I want you to ask yourself at every price point is this: who is left to buy? If everyone who was interested in the asset has already bought, there's no one left. And the absence of remaining buyers is invisible until the first sellers try to exit at a different price than what was expected. Now, everything up to this point in our conversation was diagnostic. Let's talk operational. The single worst exit strategy in this hobby is waiting until you feel like selling. Emotion-based exits get you one of two outcomes. You either sell too early because a dip scared you, or you hold too long because a thesis became identity and you couldn't separate the two. Neither is a strategy, both are reactions. Finance has a framework for this that translates almost perfectly. The first principle is that you will never sell the absolute top. The top is only visible in the rearview mirror. Anyone who claims they sold the top is either lying or got lucky and will attribute the luck to skill. Ego has no place in a portfolio. So the professional standard is not to sell at the top, it's to capture the middle of the move. The bottom 15% goes to early speculators who take on the most risk. The top 15% goes to the last buyers who are greedy at the peak and then absorb the reversal. Your job is to get that 70% in the middle. And this is the return that matters over hundreds of transactions. Another thing that I like to use in order to bring emotion out of this is to use 14 days as a measuring stick. If I have something priced for 14 days and it hasn't moved or drawn considerable amount of interest, it's time to either reprice that thing or reassess what my thesis is. So holding longer becomes not conviction, but avoidance. Time is the most expensive thing in your portfolio. Every day a card sits unsold is a day that capital is not compounding. The third principle I want to talk about is the scale out. Do not list everything at once, but don't hold everything to the last possible moment. Sell in tranches. Sell a portion at your first target, sell the next portion at the next level. Keep a runner with room to breathe. This does something psychologically important that finance research confirms. Securing partial profits lowers your cortisol. It removes the desperation from the remaining position. A seller who's already profitable on half their stake negotiates from strength with the other half. A seller who's fully invested negotiates from desperation and can take bad exits. The World Cup sell window I've been tracking opens in April and closes in early June, not because that's when the tournament starts, because that's when the narrative is at its fullest and the late capital is really arriving. Sell into the news cycle, not after the outcome. By the time the tournament results are known, the people who hold the trophy also hold the price risk of what comes after. The analysis is done, the catalog is priced. The next trade is somewhere else. The card market is not a stock exchange. I know that. The infrastructure is different. The participants are different. The data is different. But the mechanics of liquidity are not unique to equities. Thin markets move violently in both directions. Price slippage is real, and it comes from your own selling. The last sale on card ladder is not the price you can transact at. It is one data point in an auction room that may have 3 buyers or 30, and you don't know which it is until you try to sell. The collectors who understand this have a structural edge over the ones who do not. They don't confuse a listed price with a market. They don't assume that because a card went up 91%, that there is a buyer at 91% plus $1, waiting for them the day they decide to sell. They manage exits the way a portfolio manager manages exits, systematically in tranches with time discipline that removes emotion from the decision. Boring is profitable, exciting is how you blow up your portfolio. I hope you've enjoyed this discussion around liquidity, going over the 3 types as well as some principles that feed into those. Thank you for listening. Keep building, and I will talk to you later.